Welcome to RBC's Markets in Motion podcast, recorded June 30th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, the late June update of our Global Analyst Outlook Survey, which we conduct several times a year, pulling together the views of our equity analysts around the globe for U.S., Europe, Canada, and Australia. 4 big things you need to know. First, globally, our analysts are constructive on performance over the next 6 to 12 months. Second, driven in part by our survey results, we're making 6 changes to our U.S. sector calls. We dig in a little deeper to the upgrades of materials, staples, and REITs here. Third, while we don't make recommendations on non-U.S. sectors, we do highlight how financials is a favorite across the globe among our analysts. And fourth, improving 2026 consensus GDP forecasts are a positive outlier for the U.S. compared to our other coverage regions, which we think has been helping boost U.S. performance. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1. When we look at the survey responses globally, our analysts are constructive on performance over the next 6 to 12 months, along with current valuations and the state of demand, but they do have a negative view on the U.S. policy backdrop. Regionally, performance outlooks tilt constructive across all regions, strongest in Canada and Australia, and stronger for the U.S. than Europe. On valuations, views tilt constructive across regions and are the most constructive for Canada. On the U.S. policy backdrop, again, when we look across all regions, we found that most sectors had negative tilts, with the most extreme negative views for staples and healthcare. Communication services and financials had constructive tilts, while energy and utilities were neutral or mixed. Top U.S. policy issues in focus were tariffs and trade, followed by deregulation. Moving on to takeaway number 2. Driven in part by the survey results, within the U.S., we're upgrading materials to overweight from market weight. We're upgrading consumer staples and REITs to market weight from underweight. We're downgrading consumer discretionary to underweight from market weight. And we're downgrading communication services and utilities to market weight from overweight. On the U.S. survey results, performance outlooks are most constructive for REITs and materials, but negative for consumer discretionary and comm services. Valuation views have a slightly negative tilt for comm services and to a lesser degree industrials. Digging into the upgrades a little more. On materials, upgrade to overweight. It's a top sector in the U.S. survey results for forward performance and valuation, and we see reasonable valuations on our own quant work. Positive earnings revisions and inflows have also returned to the sector, and revisions may continue to get a boost from the weaker dollar. We see materials as a better alternative to the extremely expensive industrial sector, where our analysts are also less constructive if the trade war de-escalates. A key macro indicator to watch, the sector tends to outperform when ISM manufacturing moves higher. On our staples upgrade to market weight, our team's neutral performance outlook moves it to the middle of the pack versus other sectors. We like its attractive valuations, which we don't see in the consumer discretionary sector on our own work, and note consumer funds flows have been positive. Earnings revisions have been negative for staples, but this could change due to dollar weakness. Our enthusiasm is restrained by policy risk. Staples has one of the most negative views on the U.S. policy backdrop in the survey for U.S. sectors, along with discretionary and healthcare. On our REITs upgrade to market weight, we like our analysts' constructive view on forward performance, which ranks above all other sectors besides materials. The positive inflows that have returned to the sector, its attractive dividend yield, and its reasonable valuations. Something else that catches our eye in the survey results is a neutral view of the U.S. policy backdrop. There are no changes to our other sector calls. We remain overweight financials and market weight energy, healthcare, tech, and industrials. Let's move on to takeaway number 3. When we look at the performance outlooks of our analysts for the European and UK, Canadian, and Australian sectors, financials is a clear favorite across all 3 regions. Other top sectors varied a bit and included industrials in Europe, energy, industrials, real estate, and utilities in Canada, and comm services in Australia. Meanwhile, as is the case in the U.S., consumer discretionary is one of the least preferred sectors outside the U.S. Something else that jumped out to us when we looked outside the U.S., our non-U.S. analysts feel better about their own domestic policy setups. Our European and UK analysts are constructive on the European and UK policy backdrop, while our Canadian analysts are constructive on the Canadian policy backdrop. And we'll wrap up quickly with takeaway number 4. In our review of macro indicators and flows by region, what stands out to us the most is that consensus 2026 GDP forecasts are stable outside the U.S., but moving up modestly within the U.S., which our recent client conversations suggest has been helping to push U.S. equity prices higher. Though there are some exceptions, generally what we're seeing in our different coverage regions are range-bound interest rates, weak but stable business sentiment barometers, and weak but positively inflecting consumer confidence readings. On flows, weekly EPFR data indicates that flows to the U.S. have been weak and well below the highs that were in place last fall, but not deeply negative. Europe is still seeing inflows, but these have eased from peak substantially. Flows to Australia have been slightly positive but below peak, and flows to Canada have been improving. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.